Good evening, everybody. John here again from Option Engineer, and I hope you guys are having a great week. I myself have been trying to get back into the gym recently. I know you probably can't tell from looking at me, but I just haven't been able to get to it yet. But luckily, the combination of daylight savings time, increasing the amount of time I have with my kids in the evening times, combined with the heating up weather down here in Florida, with my two toddlers, and well, let's say my toddler and my baby, and the swing set that we have, where we have the dual wielding swing sets, I have been working my arms pretty good this afternoon, swinging them until they're toast. So, hope you guys are enjoying the good weather we've been having. Let's hope it keeps up. But in tonight's stream, I want to go through some of the big segments that I saw today on Tasty Works or Tasty Trade, and also go through my activity for the day. So let's go ahead and dive into it, and we'll start talking about whether options traders need to go international. This is something that I really had no opinion of. But before we get into it, let's go ahead and just let's come to terms here. As I had mentioned before, we have been learning some lessons, getting some lumps, felt and learned from. So if we look over here, this was that down day that we had recently, and I am going to be doing more frequently. I've been getting a lot of questions around how my account value is trending over time. And as you can see, I thought options trading was going to be easy, and I think a lot of people probably get into this business thinking the same thing. But lo and behold, we learned a little bit, and we did take a downturn, a fair amount, a good percentage of the portfolio in net liquidation value. And as I mentioned in a previous video, and I'll link it below, but a lot of that has to do with not diversifying the strategies I was using in my portfolio. At least that's the current thought that I have. So today, as you'll see as we go through our daily activity, definitely did diversify my strategies a little bit more, and we're starting to kind of lift off. We didn't have a whole lot of activity throughout the trading day today, and let's just kind of see what happens. My overall buying power is hovering right around that 60% to 50% utilization level, so we'll keep going with that. What I want to start doing on these streams, because I think is extremely valuable, one of the things that we are all low on time with, and we just don't have a lot of time to watch all the great content that gets put out there. So instead of trying to rehash everything, I just want to get some of the takeaways that I gathered from watching Tasty Trade either during the day or from a previous segment, or if I'm doing some research and I find it helpful, just to kind of share that. This is a log for myself to kind of capture and digest the information that I saw. And I'll also definitely giving all credit to Tasty Trade in the content they're putting out there. I just hope I can help reach more people to come into, hopefully what is the light when it comes to financial security. So tasty takeaways of the day. There were two segments that I wanted to call out: the options jive and the market measures. And during the options jive today on March 22nd, when this is being recorded, they talked about defined risk versus undefined risk, and how there's a perception out there where defined risk is seen to be safer because your max loss going into the trade. And in that regard, yeah, it's true. The common knowledge is true that that's only how much you can lose. But there is a lot of misconceptions to that the team went through today, and I definitely recommend you check it out. I won't go through all the results with you here, but you have to really ask yourself, how do you define your risk? Because if it's just with margin requirement when you're going into the trade, then yes, there is less margin required to do an iron fly than there is to do the straddle, or a strangle versus an iron condor. The iron condor requires less buying power to get into that trade. But if you look at the average win to loss of those strategies, if the research team looked several years back of different strategies, the iron fly versus the straddle, as well as I think it was the put spread versus the naked put, or it could have been call versus call spread. And what you find is that even though the buying power reduction was orders of magnitude less on the defined risk trade, the actual average win to average loss the average loss of the defined trade versus the average loss of the undefined trade, that was much more neck and neck, in the order of 3 times more loss on the undefined trade than the defined risk trade. And what that starts to do is, if you extrapolate out, if you were to pump all that margin into defined risk trades, which I did, right? I mean, I was using 50% of my buying power all in defined risk trades, all in very similar strategies. And what you find is that you can't really defend those trades as well. You have less management capabilities. You can't always roll them out in time for a credit and some of the other things that are taught. It also requires more legs, which just means more commissions, even though the Tastyworks commission rate is extremely low and easy to handle. It is what it is. There's just more commissions. Hey, wifey. And you have a lower probability of profit, right? Because you're buying those wings to protect your short call or put. And so that's going to cost you something. And by lowering your pop, it's also worsening your break even. So defining your risk, while it makes you feel safer, there's a lot to it that really, after taking that segment away, I'm looking forward to when I commit more and more capital to options trading so that I can increase the number of undefined risk trades, the more strangles that I'll start putting on. And that's going to come as I grow in confidence, and I'll share that journey with you guys as well for sure. The next segment that I wanted to just touch on very briefly is the market measure, which talked about international equities, and they sought to answer the question, if volatility is overstated with U.S. equities, which is what they've always studied historically, does the same apply for international equities? And I was thinking, of course. And luckily, I was correct. You definitely do want to diversify into international equities because fear, meaning volatility, is still overstated by a very similar margin. And also, you achieve the diversification benefits of having U.S. versus international equities in your portfolio at the same time. Now, over time, as businesses become more global and everybody is working on the same time frame at this point, diversification between international equities and U.S. equities have definitely gotten more correlated. And I looked recently, the EFA, which is the Developed Markets International ETF, is about a 0.6, 0.65 of the last 3 months correlated to the S&P. So that means that you're getting some diversification benefit from that. But again, it's not going to be like a -1 or anything. You're going to move in tandem to some extent with the U.S. market. You also have good liquidity in a select few ETFs. Your EFA, your EEM, which is the emerging markets, EWZ, FXI. There are several out there, and luckily, if you're using Tastyworks, that they should be included in that Tasty Trade default stocks, so you can check those out there. And just because the fact that they're not moving in tandem exactly with the S&P 500 or the U.S. equities, you're going to allow yourself to get more occurrences. Here's another basket of stocks you can trade. Again, we don't necessarily follow the news so carefully, so having those additional occurrences just helps the law of large numbers play out and help us long term with our overall success. So those are our takeaways for the day. Let's go ahead and not waste any time and pop into our platform. Let's go ahead and pull this guy up. And so here we're sitting today. So again, you saw it in the graph, not a whole lot of movement upward, but didn't lose any money today. Increased a little bit, which is always good. And you see our buying power sitting there how we want it. If you looked at the beginning of the market trading, you would see that my deltas were extremely high. And that was because I was very tightly positioned with a whole bunch of iron flies over the current location of the market. And in the morning where the market opened up, it was, kind of relatively, it was that far away. So over time, the market did creep up a little bit higher, which definitely helped. And I always want to balance out and keep my portfolio delta neutral. And I did get a comment about asking why, if I'm not a market maker, do I care about delta neutrality? And I do have a live stream where I talk about that, and we'll talk about it in a later time as well as I begin to understand it more and more. But essentially, the short answer is I don't know where the market's going to go over the next 30 to 45 days. So if I know the probabilities of where that market's going to be over the course of here, we see the next let me get my face out of here for you. So since I don't know where the market's going to go over the next 58 days, I might know where it's going to go over the next 58 years. I know it's going to go up. But in the shorter time frame that we're dealing with options, I don't know. And you don't know. And if you think you know, trust me, you don't know. So I don't want to pick a direction, which is essentially what you're doing if you don't manage your portfolio delta neutral. And if you're picking a direction, let's be honest, you're gambling over the next 58 days. So if you're going to pick a direction, go ahead and pick long, buy the S&P index, and turn your computer off. But that's not what we're here for. We want to actively manage our money. So without further ado, I did make some trades today. We'll go into my activity page here. And trades made today kind of in descending order by time. When the markets opened up, I did have a call credit spread that closed at my limit. Now, this is one of those where limit orders may not always be the best way to go. Let me talk to you guys for a second here about this. The beauty of good till canceled limit orders is that you can walk away and let the markets just kind of work for you. And that's great in most cases. However, it could come into the place where as the market first opened, as you see here, this trade was placed at 9:31. So right after the market opened, I might have been able to get a much better fill, or maybe not a much better fill, but I might have been able to get more pennies out of this trade had I manually placed that order in. I placed out my profit target. I achieved my profit target, which the original trade on here was for 44 cents. So by closing at a 22-cent debit, I achieved my 50% profit margin. But, by not micromanaging that trade, I could have, gotten a few more out of it. For the discipline of it, though, it's definitely still worth using those good till canceled orders in my particular scenario with my busy work schedule. So moving through here, Qualcomm was the first trade that I entered, and it was a call spread. And as you'll look on here, so this was my activity for the day. You can tell my portfolio was significantly bullish. It was overly bullish when I first came in. So what's nice about this, my agenda is set for me. Whatever the market does, I'm going to respond to. And so my trades were all call credit spreads today. And as you can see, by the end of the day, I achieved my result of getting back a little bit bearish, which is right now my current market assumption. So let's go ahead and look at how Qualcomm sets up. And Qualcomm was not an opening trade. It was really an adjusting trade. So let's go ahead and show you what I mean by that. So if we look up here, I placed the trade for the call spread. So I started out here where, again, the market rallied a little bit today. So Qualcomm went up by 0.4% over the course of the day. So if you came in at the beginning of the market, it had breached my break-even point on this trade. So mechanically, what I want to do is when it breaks through the tested side and becomes negative on my P&L, I want to go ahead and compensate for that by selling the equal and opposite call spread, which does nothing to increase my risk. My risk stays at that same level because as you can see, I had a 2.5 wide put spread here. So a $2.5 wide call spread is the same exact level of risk. I've only put that risk on the upper side as well. So I did lessen my probability of profit. And as we open up this other leg of the trade, so you can see now I have a very tight iron condor, which I'm perfectly fine with. The goal at this point, there's plenty of time left. We can watch to see what this thing does. There may be an opportunity, depending on what happens if it continues to get tested. I may be able to roll it out in time, but if not, being able to close it for a scratch should be doable here. Moving on to the next trade of the day was a call credit spread in the market itself, and this one's a pretty cut and dry. If we check out where my S&P positions are sitting, it also was an adjustment trade. So same exact story as Qualcomm, which makes sense. They're very correlated. And everything kind of had a rough day yesterday. So as I come in, I see implied volatility has raised. It's a good time for me to be selling premium, which is the goal here. So with my, it's really a mirror image. We won't go too much through the logic because you guys get it already. But here you see S&P is still having breached the short side here. So by placing this trade on, I give it an opportunity to fall back into my profit window. And now that this thing looks much more like an iron fly, I'm going to manage it like an iron fly. So I'm going to look for that 25% of max profit here. And I'm not going to do the math right now because that would just be embarrassing for me. But you can see that by reducing your probability of profit window, it only makes sense to reduce your expectations for outcome. But I've increased my overall credit received, so it's going to come out in the end. On to the next one here, XLF. This is the financials sector ETF. And if we look at this one, checking out over here, 26.17 implied volatility rank over the last 52 weeks. In this environment, even though we had a little pop in IV yesterday and today a little bit, it's still pretty good. The overall IV of the market is still a little bit sluggish, so it could be picking up. Who knows? I'm still very new and I know nothing, so we'll see what happens. But if we look at XLF, very, very low priced security. It's only where are we at? $24 or so. And so, mechanically, I want to set my probability of profit window right around 70% when I first open my trades. That's around your one standard deviation. So by setting that up, I've got probabilities kind of on my side here, and you can see low price stock here at 23.5. So again, now that I'm putting on a call side, if we do have a rally back in the market, the